Hello everyone! In this video lesson, we continue our discussion on national product, national output, GDP, economic fluctuations, and growth. In the previous lesson, I've introduced you to the difference between micro and macroeconomics. We have covered that microeconomics is a part of economic theory which analyzes individual markets, individual behavior of consumers and companies, and individual decisions they make regarding purchasing a particular product or price or quantity for the output they produced, and so on. While macroeconomics, the subject of our next half of our module, is concerned with the national economy, with total economy as a whole. Previously, we have also covered different macroeconomic indicators which we are going to analyze throughout the rest of this module. So we have learned that there are a few main macroeconomic variables: level of GDP, total production level, gross domestic product, the rate of economic growth, which determines how standards of living are increasing in a particular country, unemployment level, which determines how well the economy utilizes its labor resources, inflation, which shows how quickly prices are growing, and a few balances: budget balance and balance of payments, which determine whether the country is living within its means. There are a few main macroeconomic indicators which also determine main macroeconomic policy objectives. So every country, every economy, every government and central bank will try to achieve the high and sustainable rate of economic growth, low unemployment, low and stable inflation rate, and avoidance of deficits on balance of payments and budget deficit. Country usually also tries to avoid excessive exchange rate fluctuations. These are a few main macroeconomic policy objectives, and in the previous lesson I've explained that it is impossible to achieve all objectives at the same time because they contradict to each other. So today we will focus on the first macroeconomic policy objective, on achieving high and sustainable growth of national output. So we will study what national output is, what is national output, income or expenditure, how we can measure these parameters using gross domestic product, and how exactly it changes over time. What are the short-run fluctuations in GDP, and what is the trend for the long-run growth? So this is the subject of today's lecture. So let us start. GDP, or gross domestic product, is probably the main macroeconomic indicator. It's the most commonly used measure of national output. Strictly speaking, it's simply a value of all output produced in the economy over a certain period of time, a month, a quarter, a year, or so. So it's the value of all production activities in a country, value of all output. In macroeconomics, GDP can be measured in three different ways: as national output, as national income, and as national expenditure. And because all three methods measure the same thing, they should result in the same figure. In other words, all of these variables should be equal to each other. So strictly speaking, in macroeconomics, GDP, national output, national income, and national expenditure are all identical. They're all the same. And this is exactly what we will plot along our horizontal axis on a graph. In the previous lecture, I've shown you the difference between micro and macroeconomic way of thinking and how exactly this difference can be represented in a single graph. So I have shown you that microeconomics, which analyzes an individual market, will have individual price along vertical axis and individual quantity along horizontal axis, individual demand and individual supply. While in macroeconomics, we will have price level, or a weighted average price of all goods in a country rather than individual price. And instead of individual quantity, we will have total output produced in our country. In other words, this is where we will plot our GDP. It's GDP, national output, national expenditure, and so on. And usually in macroeconomics, we use letter Y, which stands for yield, total yield in a country. Instead of demand, we will have aggregate demand, all demand for all goods in a country. We will study this today as well. And aggregate supply, which measures total production of everything in a country. And in order to explain this whole idea in more details, I'm going to draw you a diagram. So let us start. The first step: there are different sectors in the economy, and the first sector which we are going to consider is households. All people in the society, in our economy, live in households. Even if you are single, you are considered as a single-person household. What is interesting is that all resources in the economy belong to households, and there are 4 types of resources which are used in the production process. This includes labor, capital, land, and entrepreneurship, special intellectual ability to combine all other factors of production to create profitable businesses. So these are our households. Some flowers. I've tried to draw some flowers here to show that we live in houses. These are households, first part of the economy. The second part of the economy are businesses or firms. These are some businesses which work, operate factories, and produce some goods and services. These are firms. These 2 entities, these 2 sectors of the economy interact through 2 markets. The first market will be outputs market. Output market. This is where goods and services are sold and purchased. Goods and services. And another type of market is the inputs market, where all resources or factors of production are purchased and sold. How exactly does this interaction take place? As households own all resources, they offer these resources for sale in the inputs market. So sell resources. For example, if you are just a worker, if you don't have any other resources, you don't have any rented properties, you don't have any capital, you will be able to offer your labor services and you will be paid wages as a reward for your work. So when you try to find a job, what you are doing, you are selling your labor to companies who need workers in order to operate their production processes. If you're a capitalist, you lend your capital to those who need it, who need borrowed funds, who need money in order to invest into their businesses or into some of their investment projects. They will generate profit and will pay you interest as a reward. Landowners will provide some rented spaces, rented properties against to those who need them. So households sell their available resources in input markets, and firms purchase these resources. Materials, labor, and so on, in order to start their production process. Then they transform these resources and produce output, produce certain output, which is goods and services, and they will be able to sell these goods and services in the output market. Sell to whom? Sell to households. Households will purchase these goods and services. Purchase goods, which completes our first flaw in the circular flaw diagram, which we are analyzing. However, there will be a second flaw going in the opposite direction. How do households purchase different goods and services? In what way? What do they do apart from getting these goods and services? They pay for them. In return for these goods which households are buying, they will pay for their goods. Pay for goods. And firms will receive these payments in the form of revenue. They will receive revenue, and they will use this revenue in order to pay their suppliers. They will pay for resources. They will pay to their staff, they will pay their bank charges, they will pay to the landlords, and also they will pay to the shareholders. So they will return some of the value they've created to people who invested in their business, and they will distribute all this profit. Households will receive payments in different forms, receive rewards, receive payments for all these resources which they are sold. For example, labor will receive wages, capital owners will receive interest on the money they've provided to borrowers, landlords will receive rent, and entrepreneurs or businessmen who have created these businesses will keep profit, share of the profit generated by their firms. And as a result, households will receive this income, and then they will be able to spend this income on goods and services which they want, which completes the second flaw in our circular flaw diagram. So basically, what do we see here? There are 2 sectors of the economy, households and firms. There are 2 types of markets, output market and input market, and there are flows in this economy in 2 different directions: flow of goods and flow of money. Flow of goods is shown in black, shown by black arrows, and flow of money is shown in green. green box, green money, shown by green arrows. So this is circular flow of diagram. And GDP, or gross domestic product, will measure the total size of this diagram. The more we produce, the bigger is this circular flow, the more money and goods operate and circulate within our economy, the bigger our economy will be. So GDP tries to measure our size, total size of the economic pie which our economy has produced using different techniques. And that is why I mentioned that there are three possible methods which can be used to calculate GDP: as national output, as national income, and as national expenditure. Have a look, if we come back to our slide. National output will value all goods and services produced by all firms in the economy using so-called production method or product method. Let's have a look how it will look like on our diagram. Our firms have produced certain output. Let's imagine that they've produced, let's say, 10 cars and 100 bottles of milk. We have different types of companies, and this is what they've managed to produce. This is the total quantity which they've produced. We need to incorporate the price of these products because apparently cars require more resources to make compared to one bottle of milk, and the value of the total output is higher. Let's imagine that the average car is worth 20,000 pounds and an average bottle of milk is worth £1. What will be the total value of output produced in our economy? 10 cars, 20,000 pounds each, implies that the value of all cars produced by our firms will be 200,000. And we can also add here 100 pounds worth of milk, which our companies have produced. So the combined value of all goods and services generated by our firms in a particular time period will be 200,000, and 100 pounds. This will be the value of our output. And this is exactly what the national product is. This is exactly how we measure GDP, gross domestic product, using product method as national product or national output. This is the national output, the value of all goods and services produced in our economy. So strictly speaking, we try to measure the size of this black arrow. We try to measure the flow of goods and services from firms to the output markets. This is national output. The second method, which can be used to calculate GDP, let's have a look at our slide, is national income. In other words, what we can try to do, we can try to measure the size of our flow in our economy as the value of all income paid by firms to households in return for land, labor, capital, and so on provided. This is so-called income method. So have a look. If we try to measure this arrow, all income paid by companies to households, we will be able to calculate national income, total income. So let's make it in red, national income. So we will try to add up wages plus interest payments to capital owners plus all rents earned plus all profits kept by businessmen. And if we add up all these rewards to different factors of production, we will be able to calculate total national income obtained, received by households in a particular time period. So because we measure the same flow within the same diagram, but at different places of it, we should get the same number. National output will be equal to national income. And the third way to measure GDP will be national expenditure. National expenditure is calculated as total value of all spending on goods and services in the economy using expenditure method. If we try to calculate the size of these particular payments and purchases, we will be able to calculate the value of national expenditure, how much money was spent on goods and services in a particular year. So this will be national expenditure, how much money was spent. And apparently we will be able to purchase as much as was produced, and depending on how much money we actually have. Yes, there might be some discrepancies, short-term discrepancies. For example, you save a little bit of money and you don't spend it all, and we'll come to this slightly later. There might be some leakages from the circular flow, some flows which reduce the total expenditure. We'll come back to this a little bit later. That is why I've shown you that GDP, or gross domestic product, or the total value, total measure of national output in the economy will be the same as national income and national expenditure. And that is why in economics we will use these terms interchangeably.